Inflation is too high for you. That was the takeaway. Was that the right takeaway from your speech?
Absolutely. Inflation is too high.
But aren't you guys done raising rates?
Well, so first of all, we haven't said we're done raising rates. We made a decision in our May meeting to raise the federal funds target range, as I said. And we didn't make a decision of what we're going to do in our future meetings. But it's definitely, or what's, how the economy is going to evolve will obviously affect our decisions. I do think that we've made incredible progress over the past year or so, bringing interest rates from close to zero to a little over 5%. I think that brings real interest rates or inflation-adjusted rates to a stance that should help bring inflation down. I think what we're going to need to do, as we always do, is be data dependent. Going to continuously and on an ongoing basis reassess what the data are telling us. Like I said, I'm very focused on what's happening with the credit conditions, but also what's happening with inflation data, what's happening with employment data, and then make the decisions based on what the data is telling us. I think that I always go back to, we need to make sure that we bring inflation back to 2% on a sustained basis.
But here's the thing, in the last statement last week, you guys took out a very key phrase that some additional policy firming, some Fed speak that indicated that you were still raising rates went away.
It's a very artful Fed speak, I think was the phrase.
Did you write it?
Yeah, it's a committee document. But yeah, we did change the statement. And I think there's an important, that is an important.
But wasn't that a signal that you're pausing?
No, what's a signal in our earlier language was clearly before that we saw the need. There was going to be appropriate to continue to raise rates. Now, what we've said is we're not signaling we're going to raise rates at each, the next couple of meetings. What we're signaling is we're going to make sure that we achieve our goals, and we're going to assess what's happening in the economy and make the decisions based on that data. And if additional policy firming is appropriate, then we'll do that. But if you think about this language of forward guidance, we're moving definitely back from very explicit directive forward guidance. Here's what we're planning to do. To one of we're going to be watching the data and making the decisions on a meeting by meeting basis. So
is June on the table for you for a rate hike?
Well, my view is we're going to get a lot of data between now and our June meeting, and we'll get more data as the year progresses.
But so far, we've had some data. We had a good jobs report. That was a surprise.
So I think for me, it's really assessing. Well, again, speaking for myself, that it's really one of the things that I'm very focused on is how are we seeing the tightening of credit conditions? We've seen that there's tightening of credit conditions. So one question is, how big is that? How big of an effect does it have on jobs, on the economy, and on inflation? So that's one question I have that I'll be wanting to assess, plus watch all the data. So again, I use the phrase totality of the data. And when we get, between now and the June meeting, we'll have more information. We'll make a decision at that point, and then we'll meet again in 6 weeks after that.
The market thinks you're done and thinks that you're going to be cutting rates this year, which I know Chair Powell always gets a question and he says, nope, we're not looking to cut rates this year. Do you see any scenario where you would be cutting rates this year?
Well, in my baseline scenario, I see the economy continue to grow. I see inflation coming down gradually. So in my forecast, we need to keep a restrictive stance of policy in place for quite some time to make sure we really bring inflation down from the over 4% it is now all the way to 2%. So I do not see in my baseline forecast any reason to cut interest rates this year. And I will say that at some point further out in the future, of course, if my forecast comes true and inflation is moving back to 2% and the economy is performing as expected, then of course at some point we do need to move interest rates back to more normal levels. But I don't see that happening this year.
Do you see it as a problem that the Fed and the market are on different pages?
Well, I don't know if the Fed or the market, maybe this is a good topic for some of the questions from this group, but I'm not so sure whether the Fed and the market are on different pages. First of all, the market is made up of literally, millions of people who are investors and involved in decisions. And so there isn't one voice of the market. So we talk to market participants at the New York Fed, on a regular basis. There's a range of views what's going to happen on interest rates, and there's a range of views what's going to happen with the economy. So if you look at surveys of economists or market participants in the past, that can be very different than I think, what most people look at when they hear what's the market expect, which is this market implied path of interest rates. And typically the market implied path of interest rates from futures markets does show a steeper decline. And that probably reflects some uncertainty and risks that investors see or market participants see. I think that the modal outlook, is probably doesn't have the same path of interest rate declines that you see kind of in some of the market implied rates. But I don't see this as a problem. I mean, we're making our policy decisions to achieve our maximum employment and price stability goals. I think we've communicated pretty well why we're doing those, and we're committed to achieving those goals. And so we'll just, communicate as effectively as we can, depending on how the economy evolves. I mean, I think market participants and others will understand that, and those expectations may change because depending on how circumstances change.
You mentioned the high inflation rate, higher than you'd like, higher than comfortable. But a lot of people say, look, the inflation expectations are low and have come down. So the Fed shouldn't really be too worried about inflation. And so chill out a little bit on raising rates.
I view myself as pretty chill,
You're chill today.
But
you won't confirm a pause though.
So on the issue of inflation expectations, this has been something that I think is really important. We've learned from the 60s and 70s in the US and in other countries, when the public doubts what the Fed's trying to do or central bank's trying to do, inflation expectations become unanchored. That makes inflation, actually pushes inflation higher, and you get that kind of wage price spiral that we've seen at times. We're not seeing that today. So the inflation expectations being well anchored is a very positive thing, but that's not all we need. We actually need to get our economy back into balance. We need supply and demand to be in balance, and we need to actually get inflation back to 2%, not just be kind of satisfied with the fact that people expected eventually to get back. So we need to take our actions to support that outcome.
Right. In other words, you don't want to take it for granted that those inflation expectations are low. Are you surprised at how sticky some of the parts of inflation have proven to be? I mean, milk prices are down more than 30% from the cycle highs, and yet food inflation is stubbornly high. Why?
Well, again, I think, one of the things that's happened that has been a surprise, and it continues to be a surprise, is I think the effects of the pandemic, and not just the direct effects of COVID, but all the effects it had on behavior and the decisions that people made, businesses have made, the changes in what we buy and do, have just continued to have kind of effects on supply and demand in our economy. And as that changes, you see, some sectors suddenly have a lot more inflation, others, actually have deflation, as you indicated. So there's just a lot of churn, if you will, going on in supply and demand. And so it's not a business as usual macro economy right now. So it is a surprise. I mean, and exactly how this played out, I think many of us, including myself, expected more of a pivot from goods to services earlier. But what we actually saw was, people continue to buy goods at a high rate, and we're buying services. So that's what led to demand exceeding supply. So what's the lesson to me on this is, first of all, it's still a very unusual circumstances. We have to be nimble. We have to watch all the data in all of its different ways, and again, make the best decisions we can.